Hi everyone, this is Rob on the Sui Juris channel, and thank you for joining me today. Today I'm going to be continuing the discussion that I started in a Seeking Alpha article, and as you can see I'm writing the article here, and hopefully we'll have it posted in the next day or two on Seeking Alpha. The continuation will be this video series where I'll do my summary and predictions, and I'll post that at the end of this video when it's available. So let's quickly go to the summary of the article. We're talking about why a continuing dollar melt-up may cause a stock market decline. So far, the US dollar has been surging against other currencies in 2018. The move is closely correlated with Fed interest rate hikes seen in 2018. Emerging market dependence and exposure to the dollar is causing worldwide economic currency crisis and contractions, and the reduction in cheap credit, the surging dollar exchange rates, and the globalization of U.S. firms into emerging markets will likely cause the U.S. to reach an economic recession. Let's get into the guts of the article. Here you can see a chart I have on the U.S. dollar index, and that is the U.S. dollar relative to a basket of other currencies. And this has been going up in 2018. Now that does not mean that the U.S. dollar is gaining value in and of itself against the prices of goods and services in the market. It just means that the U.S. dollar is less weak as a currency relative to the other currencies in the market. Here is the U.S. federal funds rate, and you see an increase in the federal funds rate in 2018. So as the Fed has been raising interest rates, it has been pushing up the dollar, or at least we see a correlation in the rise of the dollar. And I'll show you where I think those two are more than correlated. There's some causation there in the article. So why would the interest rates increase the value of the US dollar? We can see here that emerging market exposure to the dollar has increased. So according to Business Insider, the emerging markets now have over $2.7 trillion in dollar-denominated bonds and loans maturing by 2025. And we can see that Turkey, Mexico, and Argentina lead, and that their amounts have increased substantially since 2008, in some cases almost doubling since the last financial crisis. Other countries, Indonesia, Saudi Arabia, Russia, Malaysia, South Africa, Brazil, China, and India. So you can see that the emerging markets have fueled their growth based on dollar-denominated debt. It's no surprise, however, that as the U.S. dollar has strengthened this year, that currencies in these countries that depend on access to that dollar and the cheap dollar have struggled. And rising interest rates have caused an increase for demand in U.S. dollars because increased finance costs require more dollars for servicing the debt. The capital inflows into emerging markets decrease as the U.S. dollar rises, causing more exchange out of other currencies into the dollar. And investors move money from foreign banks to U.S. banks now to take advantage of this yield that the U.S. banking system will have as a result of the increase in interest rates. If we look at actual dollars in circulation, however, we see that there's much less dollars available than the demand for them. So there's about $1.6 of actual currency in the markets. However, we know that the emerging markets by themselves have over $2.7 trillion in dollar-denominated bonds and loans maturing in 2025. And we're not even talking about U.S.-related debt. So there's much more debt in the system that's going to want to draw on those actual physical dollars in circulation than are available, and that's raising the value of the U.S. dollar. If we look at debt overall in the cycle, we can see that debt has exploded basically since 1996, but also especially since 2008, where corporate securities, mortgage-backed securities, treasury securities, all of this debt has exploded in the system to where we have over $41 trillion. The debt will drag down stock markets. If we look at this chart from Moody's Analytics depicting corporate debt levels just before an economic decline, once we get to that 45% of corporate debt as GDP, we have a recession or we're already in a recession as depicted by these gray bars. So at this point, we should actually be in a recession according to how much debt we have. Now, it will be interesting to see in subsequent quarters if we go back and say, yeah, we officially hit recession in 2018 in the United States, or whether that be 2019. The debt levels are indicating that we probably should be there, but we'll have to wait for some of those economic numbers to come out to actually confirm it. In the summary, I'm talking about how the Fed's policy may seem at odds with the interests of those who hold U.S. debt and dollar-denominated loans, and that may well be true. However, the Fed is focused on a quantitative tightening program to control inflation levels and what it feels is a strong national economy. And I'll tell you the two factors that you're using to determine strong national economy here in just a moment. I'm arguing, though, that eventually rising interest rates should slow growth by reducing cheap credit available for expansion and reducing profit levels because of the financing costs of that debt. and the reduction in U.S. dollars available will drive their value up, at the same time become a negative feedback loop for the world economy. And the question I have in this article is, will the U.S. face a new financial crisis as the dollar exchange rate surges, as we saw in 2008? In other words, could this be a repeat of 2008? We'll see as we get further into the video. Now, the Bureau of Labor Statistics is printing the unemployment rate, and that has fallen from 2008 from about 10% down to about 4%, or a little less than 4% in 2018. So if you just looked at this rate, you would think that unemployment is very healthy, and this is one of the two statistics that the Fed is using to determine how strong the economy is. The problem with this unemployment rate is this factor leaves out people who are discouraged and are no longer looking for jobs because they've been unemployed for so long. So in other words, the unemployment rate does not depict the total amount of people as a percentage working in the economy that want to work in the economy. All it does is say less people are unemployed than before that are still actively looking for jobs. But as about a year or so of time goes by and people aren't finding jobs, they're just rolled off of this number. So that's one of the reasons for the decline. If you look at the BLS's same statistic on the labor force participation rate, which I have published in previous articles on Seeking Alpha and also talked about on this channel, we see that since 2008, the U.S. has gone from 66% employment of eligible adults down to 63%. So we've lost 3 percentage points of eligible employment. So while the unemployment rate for currently active-looking people has fallen from 10% to 4%, the overall employment in the United States has actually fallen 3%. And that's why I think the Fed has gotten it wrong, because they need to look at the labor force participation rate as well. Not just looking at the current year values on people looking for jobs and finding them, but on all of the people in the economy that want to look for jobs. Because if you've been looking for a long time and you can't find it, that's an indication that your overall employment is actually weaker than it was 10 years ago. And that could be some structural issues that they need to look at, and whether the U.S. economy is as strong as they think it is. The second statistic in which the Fed looks at is the U.S. consumer spending. And as we can see, consumer spending has gone up. However, one thing that's not depicted in U.S. consumer spending is how much debt the consumer has. And while I don't have the chart here, all of the indications in the market, all of the charts that I've seen, are that the U.S. consumer is spending more on credit. They're financing more of their house, and there's less skin in the game of the house. It used to be you had to have 20%. Now you can get a no down payment loan where you don't have to put any skin in the game. They're also getting these longer-term 4 and 5 and 6 year low interest rate auto loans where they're not putting any money into that deal either. And the credit card debt has gone up to all-time highs in recent years for consumers. So yes, while consumers are spending, a lot of it is going based on debt, and it's not an indication that they're able to actually pay for these things. And that's probably because the overall labor force participation rate has actually fallen from 66% to 63% over the last 10 years, which has caused consumers to continue to spend, but to do it on credit. That doesn't mean that the economy is super healthy. I think there's an alternative motive for why the Fed is raising interest rates and increasing the strength of the U.S. dollar. As we've seen in previous videos, the emerging markets are having currency crises, and emerging market stocks are coming down as their economies slow. We showed that all the way from China to Germany to the Latin Americas. I've done several videos on that in the last 2 months. Please look further on this channel for these current news and analysis stories where I'm looking at the emerging markets and how much they're suffering. There's a lot of data there for you guys. And what's happening is emerging markets suffer. It's causing the U.S. Current account to come more into balance. So we've had a reduction in the deficit in the U.S. current account because of the rising interest rates, which has caused those economies to slow down and them to output less. It actually plays into the United States' favor as far as the current account goes. It means we can export more relative to what the emerging market economies are doing. And that is better long-term for our economy. So I think the Fed is actually, and because of the Trump administration and what Powell is trying to do to the economy, they're looking at their current account as the biggest risk to the system. If the U.S. is continuing to finance the rest of the world, it could lead to big troubles in terms of the U.S. debt levels. So in order to bring the U.S. debt levels down, they've got to address the current account. And I think that's what the rising interest rates are doing, because they know that everybody in the world is so dependent upon all of this cheap credit and this availability of dollars. If they restrict the amount of dollars in circulation and they raise interest rates, that affects the emerging market economies, which causes them to have issues with their economies and slow their exports, which causes our current account deficit to shrink. And I think they want this number to continue to go in this direction. Instead of having these huge current account balances, they want it to reduce all the way up to zero so that the United States is not having these issues. And I really think that's why they're doing it. However, I think that the economy could crash before they're able to do this. And I actually addressed this in a previous video. I don't think that they're going to be able to get the current account even before they crash the world economy. And that's because the world is globalized. And so when you just look at the United States, their current account balance in the United States health of the economy, and you're not looking at the rest of the world, but the rest of the world is using your dollars in debt, and the rest of the world is dependent upon that, and the United States is dependent upon that for their imports, then we see more of a globalized picture. And further, as U.S. corporates have expanded out into these emerging markets, into these other markets, the U.S. stock market could crash as a result of these decisions by the Fed to continue to raise rates. And that's really what my prediction is going to be. My prediction is going to be in 2019, if the Fed continues to raise rates because they're looking at these statistics in the economy, which are flawed and don't really show the true health of the United States economy in and of itself, they're going to cause more and more chaos in the emerging markets, which is going to cause chaos in the U.S. corporates, because the U.S. corporates have their own debt and their interest rates are rising because a lot of that is floating rate debt. It's not fixed rate debt. There's a huge portion of debt in the U.S. economy which is floating rate, both for consumers and for companies. And also in the emerging markets have the same thing. So as all of this debt financing cost goes up, it's going to slow the U.S. stock market. And it's going to crash the U.S. stock market. And I expect that we're probably headed into both a recession in the U.S. economy, and we'll see the continuation of the decline of the U.S. stock market in 2019. Here's a good article written by Jesse Colombo at Forbes, which discusses some of these problems. And I want to look at a chart down here where he's talking about corporate debt has increased by 2.5 trillion, or 40% since its 2008 high. And remember, if we go back to my article, we only have 1.6 trillion available in currency. When you have this much debt outstanding and it has to either be refinanced, rolled over, or paid off, there needs to be dollars to pay it off. That's what happens in a debt-based fiat money system. You have to have dollars to pay off that debt. Well, there's a lot more debt than there is dollars. And so as this debt is increased and the dollars are now being tightened or reduced in the economy, that's going to raise the U.S. dollar rate significantly. As you can see here, this is a chart which echoes the chart I had before, which is when you have corporate debt as a percentage of GDP reach 45%, that means we've reached a bubble and we're about to reach a crash. And you can see the recessions here on that chart. So that's just confirming what I had in the article. What have the corporates been doing with all that debt? Well, I had an article last week about how they're not spending as much on CapEx. We saw that in Yardeni's research, where CapEx expenditures or capital expenditures in order to grow those corporations has been lower than the amount of share buybacks they've done. So what the corporates have done is use cheap debt to buy back their own shares. And however, the interest rates on that debt are going to rise, which means they're going to pay more for buying back those shares than they originally thought. It means if you bought back a share at $1, but then you take into account the fact that your interest rate on that debt that you used to buy back that share is rising, you may actually have paid $1.05, $1.10, $1.15 for that share, which makes those share buybacks more expensive over time than their original purchase price, because it was done with debt that may have rising interest rates. And you can see in the stock market, as those shares were bought back, that tended to increase the stock market's value over 300% since the financial crisis. So in other words, the stock market has risen probably more than the health of the economy. Because when you look at the amount of people employed, when you look at the overall debt levels, when you look at the consumer spending, which has been based on debt, our economy has not gotten that much stronger, but the stock market has. And so the stock market is not really a good indicator of how good the economy is, which means as the economy goes into recession, that stock market has to come back down to the mean. It has to come back down to where it's fairly valued. That's why you're seeing P&E ratios so high in the market, is because of all the debt that's been used to buy back these shares, which has spiked up the stock market indice higher than it should have been. But it has to come back down. It has to revert back down to the mean as we head into this likely recession that we're already seeing in the emerging markets, which is starting to come over to the United States as well. And you can see the cyclically adjusted PE ratio, we're much higher than we were even during the Great Depression. And we're getting closer where we were in the dot-com bubble. And you can see since the dot-com bubble, we never really solved the problem. Back in 2008, we finally reached a much better PE ratio. So the PE ratio during the financial crisis is actually more in line with historical median. Right here, if you draw a line here, this is within the volatility of the historical median, within a standard deviation of that historical median. And so we should have stayed there if we actually had a healthy stock market. Instead, we've gone right back into bubble territory. So that tells you that the stock market is in a big bubble. It's in a worse bubble than it was during the Great Depression, and it's reaching that dot-com bubble proportion, which is really dangerous for stock market investors. So again, we're going to see those stock market values come down as we head into recession. And it's going to revert back somewhere to the mean. It probably fall below it. So you could see it come back down into the 10 range or so before it normalizes through the recession, back up maybe into the 12 to 15 range. So right now it's sitting at about almost 35. So you could see those P&E ratios come down by, oh goodness, 200% or so or more as we head into the recession. So if you're investing in the stock market, just understand that. If you're investing in these high P&E companies, a lot of these FANG stocks and technology stocks, and some other stocks in which a lot of technology, a lot of even consumer staple, a lot of those types of things are way too high, and they really need to come down. And if you want to invest in something you think will be profitable long term, look at areas of the market which have low price to earnings ratios, mean they're cheaply priced relative to the mean, because those will likely go up in recession instead of down. Or at the very least, they'll trade sideways and you won't lose money in your stock valuations. The record high in the stock price to earnings ratios has led to overall record low dividend yields. So that's another measure of stock market health. When you have low dividend yields, that means that the stock prices of the stocks are too high, but the companies aren't making enough money to raise that yield as a proportion of that stock price. It means the price is higher than what it should be relative to the earnings and the distributable profits of those earnings to the stockholders. So again, to get those dividend yields back up with historical mean, as you can see here, is around 3.5-4%. Those stock market prices have to come down significantly, and we have to have free cash flow. Now, I don't expect dividend yields to rise right away, because in the recession we're going to have all this debt destruction that we need. We're going to have to pay off all this debt in a rising interest rate environment, which is going to cause more and more money to be moved from available for dividends to paying off the debt. So we're going to pay the debt first before the dividends come up. So what I expect to happen is stock market prices will come down in the crash. More money will be paying off high interest rate debt. Once you've got enough of that debt paid down and the stock prices have come down, then they can start to spend money on growth, on capex, and then after they spend money on capex, you'll start to see income rise in these companies, and then you start to see the dividend rates start to rise as well. I think that could be a 5 to 7 year cycle. I think it could be 5 to 7 years before you see dividends come up relative to the stock price, because of all the debt in the market that needs to be paid off, and we're heading into this rising interest rate environment. So that's basically where I feel we're going with that. I think this is an excellent article at Forbes talking about that. And that's my prediction for 2019. And that's why I've come out in the last several months talking about where we are as an economy, where the emerging markets are, where the U.S. will be, why 2019 is likely to be a recession in the U.S. if we don't come back with the numbers 2 quarters later and say it actually started in the fourth quarter of 2018, which is entirely possible. That's normal. We have to have a quarter or two of data to make that determination to see if we're actually in recession. By the way, recessions are formally declared. But it's possible we're in recession now. But I think even if we're not now, we will be in 2019 because of all these factors. And I think it's very clear that we're seeing that in the economy. And so you want to be careful in the stock market. I think their portfolios are going to come down. And what you want to do is go from being a growth investor in these technology companies to being a value investor and looking at areas in the market which are under, have lower PE ratios, which are under their net present value of those companies are under their market caps, where they're cheaply priced. That's what you want to be investing in going into this cycle that we're in. We're at the end of the business cycle, the boom. We're headed into the recession. We're going to have higher interest rates, so much debt that needs to be cleared out. You want to get out of those growth companies and start to sell those off and come into much better positions that you won't feel as much pain. So anyway, that is the video for today, guys. Thank you so much. If you liked it, please give it a thumbs up, subscribe, and leave a comment. And until next time, this is Rob for Seeking Alpha and the Sui Juris channel.